I'm Corey Hurwitz, Manager of National Accounts with BMO Global Asset Management. My main focus is to help our discount brokerage partners, such as BMO Investor Line, providing education to help their clients make informed and thus optimal decisions. Today, I am talking with Daniel Stanley, Vice President of BMO Global Asset Management. Daniel is a CFA charter holder and brings over 15 years of capital markets experience in the United States and Canada, with particular expertise in exchange-traded funds. This is one of several conversations about smart beta and how it can be used in constructing portfolios. Today we'll be talking about the evolution of smart beta. Dan, perhaps you could start with an overview of the growth in smart beta ETFs in Canada.
Thanks very much, Corey. As is often the case, a rising tide lifts all ships. So in February of 2015, Morningstar reported that globally, in the past 2 years, strategic beta assets grew by 87% and now account for $380 billion US. The growth of smart beta ETFs in Canada really reflects the global growth of smart beta ETFs. Over the past 2 years, for example, the number of ETFs increased 49%, while assets increased 77%.
How about the overall growth of smart beta in the United States?
Yeah, in addition to the impressive 2-year growth statistics, Corey, Morningstar also notes that in the U.S., smart beta ETFs brought in 60 cents of every new ETF dollar in 2013 and 2014. Smart beta ETFs are growing at about double the rate of their market cap-weighted ETF cousins.
Dan, maybe you could talk about where this growth is coming from specifically.
So one of the big drivers of growth that we see is the participation of new buyers, specifically institutional investors. According to a study by Cogent Research that was done last year, among institutional decision makers in the United States, 25% of them are using smart beta ETFs in their portfolios, and impressively, 53% expect to increase smart beta ETF allocations over the next 3 years.
Dan, for the audience, can you point to an example of an institution that is using smart beta?
Yeah, the example I always use is the Arizona State Retirement System, who partnered with iShares and MSCI to create smart beta ETFs like the MSCI Quality ETF. The MSCI Quality ETF screens stocks for quality characteristics. Characteristics like companies with high return on equity, stable earnings that are uncorrelated to the business cycle, and companies that have strong balance sheets with low financial leverage.
Now, changing gears a bit, what are some of the key drivers of this rapid growth in smart beta?
Well, thanks to their flexibility, transparency, and ease of implementation, smart beta ETFs, also known as strategic beta, have experienced tremendous growth over the past couple of years, really because they fit into the middle of that active-passive spectrum. They take the best of both worlds. They take process from active management, and they take low cost from passive management. Smart beta ETFs are growing in effect because they give investors access to different exposures in their portfolios, allowing for better diversification and the potential for greater risk-adjusted returns.
Dan, could you talk about the roots of smart beta?
Yeah, this is a great story that I always like to tell because a lot of people don't realize smart beta has been around for a long time. It is not a new concept. There's a magazine called Institutional Investor Magazine, and on the cover of the May 1978 issue, there's a headline that asks, "Who is Bar Rosenberg, and what the hell is he talking about?" Well, Bar Rosenberg was the founder of a company called Barra, which is now an MSCI company. Bar Rosenberg was the first person to really research and use factor investing, a subset of smart beta, all the way back in 1978.
Dan, my last question. How has smart beta changed?
Well, Corey, the early ETFs were really based on the efficient market hypothesis, and in an efficient market, stocks and their market cap-weighted indices really should accurately reflect a company's value. But as we all know, humans are inherently emotional, and market cap weighting inherits the resulting swings in valuation. So it wasn't long before companies like Research Affiliates, which is the creator of the RAFI indices, and Barra, now an MSCI company, applied academic research to real-world solutions like fundamental and factor indexing, also known as smart beta, which again is just a fancy way of describing ETFs that screen stocks according to a set of rules.
Dan, thank you very much for your comments today.
Thank you very much, Corey.